key technical indicators. Moving averages. We learned about averages back in school days. The concept is the same. We take the price of last few candles and divide by the number of candles. But what price to take? Opening price, closing price, middle point. People differ a lot on this, and this can be configured in your charting platform as per your preference. I follow the default in my trading platform, which uses the closing price of each candle. For each successive candle, if we calculate this average of last few candles and plot the points, we will get a moving average curve. The number of candles in the past that you consider will determine how closely the curve follows the price movement. For instance, 9 candles moving average will hug the price much more closely compared to 50 candles moving average. SMA, WMA, EMA. This is the mathematical model used to calculate average. SMA is simple moving average, which is what we usually think of when we talk about average. Add all prices and divide by number of items. So, 9 SMA is looking at the closing price of last 9 candles and plotting the point. It does this for every successive candle to plot the curve. The problem with SMA is that it gives equal weightage to all previous prices. Analysts wanted to assign higher weightages to recent prices. Thus came weighted moving averages, or WMA. The recent prices are given higher weightage. So, the average will look like this. But it still does not solve one limitation: the limitation of the number of items taken in the average. In SMA or WMA, we calculate the average of last few candles and we keep shifting the window, but for any point on the curve, it only considers a set number of past candles. Exponential moving average, EMA, solves both problems by considering all prices in the lifetime. It assigns weights to all prices, and these weights can be altered. The older prices are not ignored, but remain available as a multiplier. Note that the influence of older data will be very small, as the weight is significantly lower. This explanation is just for your broader understanding. One need not worry about the mathematical models, as the chart plotting software would do it for you. You just need to specify the curves you need, and any other specifications, like type of average and duration, etc. I personally use 9 EMA, 20 EMA, 50 SMA, and 200 SMA. These are based on the recommendations from fellow traders, and they have served me well. Lagging indicators. One should keep in mind that these moving averages are lagging indicators, as their value is dependent on past candles. That means they are reactive to the price and show the movement after the price movement has started. The shorter the time frame, the faster would be the response, lesser the lag. For example, 9 EMA will make movements in the direction of price movement faster compared to 50 EMA, but shorter time frame movements can sometimes give false signals as the price chops up and down. See example here from a 5-minute chart for AMD. At point number 1, at 12:45 p.m., the price starts to drop, but the 9 SMA, the blue line, only starts to drop from point number 2, which is at 1:20 p.m. and 50 SMA, the red line, from point number 3, that is at 1:45 p.m. What do I use these averages for? As support or resistance lines. Moving averages can act as support levels during an uptrend and resistance in a downtrend. See the charts here. In this one, the moving average is a support level in an uptrend, and in this one, the moving average is a resistance level. Usually, the longer time frame averages are stronger support or resistance. For example, 200 SMA would be considered a stronger support or resistance level when compared to 50 SMA. As indicators of trend, refer to the chart here. While the prices seem to be stagnating in the shorter time frame, the 200 SMA, the purple line, tells us that the longer-term trend is bullish. crossovers. Price crossovers can be used to generate buy or sell signals. When the price crosses above the moving average, it generates a buy signal. Similarly, when the price moves below the moving average, it generates a sell signal. This is usually not used in isolation and only helps with additional confirmation. The problem with this approach is that the price often cuts above or below the moving averages, especially the shorter averages like 9 or 20 moving average. Look at the chart here. This is Shopify daily chart. As you can see, the prices cross above and below the 20 moving average multiple times, but never trending in any direction. This is called whipsaw. If you rely only on this approach of buying when the price crosses above and selling when it goes under, you will take losses way too often. Just when you take a position, the prices reverse, stopping you out. One way to avoid these whipsaws is to use a longer moving average like 50 or 200, but that has the downside of responding to price movements too late, as they have high degree of lag. Another common approach is to use double crossover method, using a combination of two moving averages. Common pairs are 9 and 20, 5 and 20, or 10 and 50. Buy or sell signal is generated when the shorter moving average crosses longer moving average. This approach helps reduce whipsaws, but it lags more than the price crossover method. See chart here. Here, 9 EMA crosses over 20 EMA, generating a buy signal. Here, 9 moving average crosses below 20 moving average, generating a sell signal. Volume. Refer to the chart here. The bars at the bottom represent volume. Volume indicates how much of a given financial asset has traded in a specific period of time. The asset can be stocks, crypto, forex, or any other. The time period is based on the chart that you are looking at. In the example here, we have a daily chart. So, every bar at the bottom represents the volume traded in one day. Many traders just focus on the price action and patterns, completely ignoring the volume signals. But understanding volume is a key component of being a consistently profitable trader. A lot of trading strategies use volume as a confirmation signal. By studying the volume patterns over time, traders can better understand the strengths of uptrend and downtrends. We will study this in more detail in the section Volume Price Analysis. VWAP. We just discussed the various moving averages and how we can use them in our trading. But all these moving averages, whether exponential moving averages or simple moving averages, only consider the previous price points. Volume-weighted average price also takes volume into consideration along with price, and this is a very strong moving average to have on your chart. I would always keep this indicator turned on in my charts across all time frames. Look at the chart here. The volume-weighted average price line is shown in bold. Bollinger Bands. Bollinger Bands are named after the creator, John Bollinger. They are used widely in technical analysis. Bollinger Bands are a set of 3 lines based on the price action. The middle line is commonly a 20 moving average. This setting can be changed in your charting software. Usually, the upper and lower bands are 2 standard deviations away from the main moving average. Using 2 standard deviations ensures that the price will be within the upper and lower bands 95% of the time. If the price of the underlying asset is touching the upper band, we say that the asset is overbought. And when the price touches lower band, the asset is considered to be oversold. Bollinger Bands expand and contract depending on the volatility of the market over last 20 time periods. If the price is highly volatile, the bands expand, and during the quiet periods, with stable prices, the band is narrow. Keltner Channels. The Keltner Channels indicator has upper and lower bands, similar to Bollinger Bands. Keltner channels were originally proposed by Chester Keltner in his book, How to Make Money in Commodities. Linda Raschke, who was a successful commodity trader, made a few modifications to the original definition that makes it apt for technical analysis. It still uses average true range, but the range of calculation is 10 periods. This average true range value is doubled and then added or subtracted to 20 EMA to get the upper and lower bands. The interpretation for Keltner channels is a bit different. When the prices close above the upper band, it's an indication that there is a strong possibility of a breakout on the long side with increased volatility. And similarly, if the price closes below the lower band, it indicates a possible breakout on the short side. We do not need to worry about the technicalities of these indicators at this stage. We will study how to use these in the later sections to enter and exit trades. The overview here is largely to introduce you to the key terms so that any mention later would ring a familiar bell. Pivot points. We briefly touched upon pivot points in the previous chapter, where we introduced the concept of support and resistance. As I mentioned, we will cover more details about these levels in this section. Pivot points help a trader identify some high probability levels at which the price may bounce, either in the form of support or resistance. There are various algorithms or mathematical principles used to identify these pivot levels. Some traders would prefer one versus other. Some even use a combination of these. You may explore these for your own trading strategies or for the strategies we discuss later in this course. At this stage, I would like to equip you with the fundamentals so that you are able to use them at a later stage with a sound understanding of underlying concepts. These indicators give us a pivot point level and several support and resistance levels. To calculate the values of these levels, we use current open price, previous open price, previous high, previous low, and previous close. As an end user, you do not need to worry much about these calculations, as these indicators are automatically displayed on most of the trading platforms. See the snapshot here from TradingView, where I can select the type I wish to have on my charts. Here are the calculations being done for classic pivot points. Resistance levels are R1, R2, R3, etc. Similarly, we have support levels S1, S2, S3, and so on. An example here from SPY 5-minute chart using classic pivots. The pivot points are shown in orange lines. We clearly see the level, R2, acting as a strong resistance here. Apart from these classic pivot points, there are a few other commonly used definitions. The difference lies in the underlying formulae of determining the levels. Let's discuss some of the most common ones. Camarilla pivot points. Here is an example using Camarilla pivot points on 5-minute chart for an IO. We can see that the price is respecting these levels a number of times. This one here. Then here. Another one here. Fibonacci levels. Here is an example. It's a 5-minute chart for Tesla. We can see how the price bounced off near the S1 level. Like I mentioned earlier, any level cannot be considered an iron rod, but should be taken as a soft string, and the action can happen around that level. Average true range. Average true range is an indicator of volatility. It does not indicate anything about the direction of movement of the financial asset. A higher value indicates high volatility and vice versa. As we will see in a later section, when we discuss the strategies, I primarily use this to identify the point where I should take profits, and as a check before entering the trade. Both these use cases are based on one concept. Average true range, in a way, is giving us the average volatility defined by the range between low and high levels for the given time period. So, for instance, if I am making intraday trades, then I see the ongoing ADR at daily level. That is usually the average of previous 14 days. So, if I see that the average true range is hovering around $4, then I know that on an average the stock is moving by $4 between the low and the high of the day. If I want to get into a trend continuation trade, I will check if the stock has already run through a good percentage of that ADR. If so, I will pass that trade. The stock has already moved a lot, and based on the average daily movement, it may not go further in that direction. Average true range also helps me define a target or evaluate when to take profits. I would look at it before entering the trade to see how much potential we have on that move, and thus estimate the potential risk to reward ratio. I usually go for 80% of ADR, and not exact ADR, just to be on a safer side. Let's go through an example to make it clearer. The chart here is split chart with left side being daily chart with ADR shown below. Right side is the 5-minute intraday chart. From the ADR on daily chart, I see that the stock is moving about $7 on an average. By default, average true range is calculated by the system on 14-day average, but you can change that setting if you like. I keep it at default. So, when I am doing day trading, I have that in mind that this stock, on an average, may only move by $7. And to be further safe, I take an 80% cut on that. That comes to 80% of $7, which is $5.60. Now, if I have entered a trade on the short side and am looking to profit, it's going well in my intended direction. I can exit if there is a major resistance level or if I see sign of weakness. But usually, I will let it run till it drops $5.60 from its peak, not from my entry, as the range for ADR is between high and low, and not on your entry. I would in fact use it even before entering the trade. Let's look at the same chart again. As per some strategy that I follow, let's say the stop loss and entry points are as shown in the chart. My risk, R, is defined by the difference between entry price and stop loss multiplied by the number of shares taken. Now, at 80% of ADR being the target, I can expect to make more than 2R. So I should enter the trade. If the expected return is less than 2R, I would usually skip the trade and wait for better opportunity. Don't bother about this much at the moment. We will build on this more in the coming sections.